Welcome to our podcast series, Talking with Traders, hosted by expert trader Garth McKenzie in London, from where he's interviewing various guests on the topic of trading.
Welcome back to another season of Talking with Traders with me, Garth McKenzie. This is the 6th season of the podcast, and we're into our 3rd year since the podcast began in 2020. Once again, IG have come on board as sponsor and agreed to fund this podcast for another season. We really are privileged to have such a global leader in CFDs trading as our podcast sponsor. Over the coming weeks, I'll be interviewing various guests from around the globe to bring you their market insights. I'll be digging in to find out what makes them tick, how they see the markets in the year ahead, and what techniques they will use to succeed in the markets. Some of the guests will be returning guests from previous seasons, and some will be new guests that I've managed to convince to join me to give up their time and share their insights. As we enter 2023, there's as much uncertainty as ever around where the markets may be headed in the next 12 months. We've just come off a horrid year for investors in 2022, where a typical 60-40 portfolio delivered its worst annual return in several decades. But what of 2023? Will the US lead the world into a global recession, or will the central banks manage to achieve a soft landing for the global economy? Will inflation come under control as base effects kick in and supply bottlenecks open up? Will US earnings hold up in the face of a weak economy, or will they disappoint? Will we see continued weakness in the US dollar? I'll be asking these and many other questions to my guests in the coming weeks. The idea behind these podcasts is for you to get a variety of views from a broad spectrum of market professionals. None of this is intended to be seen as financial advice, but it is intended to get you thinking and to weigh up what possible paths the market may follow in the year ahead. Please remember to subscribe to this podcast in your favorite podcast app. That way you'll be notified of upcoming episodes as they get released. Once again, thanks to IG for sponsoring this podcast for a 3rd consecutive year. Thanks for joining me, and please enjoy Season 6 of Talking with Traders. Welcome back to another episode of Talking with Traders. And this week, it is a delight to be able to welcome a new guest to the podcast series. His name is Axel Rudolph. He is an analyst with IG Markets in London. And I must say, for me personally, it's an honor to be able to speak to you, Axel, because you've been on the TV, on CNBC and Bloomberg's and what have you, lots over the years. And I remember being a younger broker in South Africa, watching the TV and watching you on various financial channels. So having the opportunity to speak to you today is a big honor. Thanks very much for joining me.
Well, thank you very much, Garth, and thank you very much for having me on Traders Corner on your podcast.
Yeah, thank you very much. Well, it's good. I'm really looking forward to chatting to you. As I do with every new guest that we welcome onto the podcast, I always like to just get a little bit of a background as to who you are. So tell the listeners, a little bit of your background. I know you've got a very long CV, very experienced in the market. So you could probably tell us for a long time about your CV and your experience. So I'm going to ask you for the abbreviated version, a little bit of background as to what you've done in your career and what's led you to get to where you are now as an analyst at IG Markets.
Yes, well, basically, I might be showing my age here, but I started trading nearly 30 years ago in a French investment bank in Paris, Société Générale, and I was basically a junior FX and fixed income trader, and started in September of 1992, which was the month when George Soros pushed the British pound out of the exchange rate mechanism. Yeah. I very quickly had to learn how to manage my risk in order to keep my job, basically, and started looking at charts. And all through my career, to be honest, I've very much focused on technical analysis. I'm a very keen follower of technical analysis. And over the last 30 years, I've used it on all kinds of asset classes that are either traded or that I sort of managed. I also worked for a time as a fund manager. And for the last 10 years, for example, I worked in a team at Germany's second largest bank, Commerzbank, as a technical analyst. So as a trader, analyst, and fund manager, I basically use technical analysis in conjunction with the usual macroeconomic and fundamental analysis, but really focusing more on the technical side, to be honest. And I've been doing that for 3 decades now, basically, all over the world.
Yeah, well, I guess we're kindred spirits then. I'm also very much technical analysis focused. Love the charts, love reading the trading action. So we'll talk more about that during the podcast, because I do want to get a little bit more insight into the way you use technicals and how you set up your charting templates, etc. But we'll get to that later. What I want to speak to you about first up is some topics that you spoke about in a webinar that you gave to IG clients recently. It was in early January or middle of January, and I watched that webinar with a great deal of interest. And you sort of teed it up by saying that the year ahead, 2023, will be very much a case where the market is going to be focusing on 3 main things. They are inflation, growth, and then central bank policy. So to kick off the conversation, I want to just touch on each of these topics, because I agree those are probably the 3 most overwhelming focal points, besides some of the tail risks and things in markets that we're watching at the moment. But let's just touch on them quickly. I mean, inflation. I presume that you're of the view that inflation has peaked, at least in the shorter term anyway.
I am, yes, definitely. The problem is, though, that it's not enough for inflation to peak. What we wanted to do is to continue to slide, and to do so, hopefully, at a relatively steady or faster pace than what has been happening recently in the last few weeks, for example. I mean, Garth, you probably saw the numbers today. We had the personal consumption expenditure out, which is actually the inflation measure that the Fed looks at more than consumer price inflation, CPI, that is.
Yeah.
And that came in stronger than expected. We had a core number out year on year at 4.7% versus a forecast 4.3%, showing us that inflation is actually quite sticky. And that obviously worries investors, because it increases the risk of the Fed not only raising rates further, but also to keep higher rates for longer than was anticipated only just a few weeks ago at the end of December, for example.
Mm-hmm. Yeah, that seems to be the issue at right now, because I think by and large the expectation, the consensus has been that we'll get another 2 rate hikes of 25 basis points each, and then the Fed will stop, and they might even begin to pivot later in the year. And I think, as you're saying, that the risk is, well, first up, are we going to get another 2 25 basis point hikes, or are we going to get a 50 basis point thrown in there somewhere? Because I've seen some Fed officials starting to utter those words recently. So perhaps the rates are going to go a little higher than what was anticipated. But then the big question, like you said, is, do rates stay high for longer? And I guess that's the unknown, because the further out we go, the more difficult it is to know what Federal Reserve policy is going to look like. And I guess they don't know the further out either. And what can we learn from the 70s here? And I think that's the period that a lot of people hark back to and look at inflation in the 70s, and they see a similarity to what we have now, where inflation spiked, then it came down, but then the central banks cut interest rates too quickly, and inflation took off again and actually ended up in quite a significant inflation spiral. Surely Jerome Powell is smart enough to know that history, and to therefore know that cutting rates too quickly could actually have very detrimental consequences.
Yes, certainly. And that's why the financial markets are starting to worry now, because basically, as you said, Jerome Powell will make sure, or try to make sure, that inflation doesn't get out of hand like it did in the 1970s, because that had a very detrimental effect on the economy, and not just the US economy, but the global economy back then. And that's the last thing we really need at the moment. I mean, we're just celebrating today, not celebrating, but we are unfortunately in a position where we've had the first year of Ukraine being invaded by Russia. So you also have risks with regards to geopolitical events taking place at the moment. And with regards to the central bank policy, I mean, the Fed is trying to bring rates down, that is to say, inflation down again to 2%. The question is whether that's even possible. I know that some major investment banks have recently said that we will continue to see disinflation in the coming month, and that by the beginning of next year, we could actually reach that target again. But not everybody agrees. And as you say, Garth, I mean, if we do have numbers like the PCE number we just had out today, which shows us that inflation is not coming off as quickly as forecast, and if we continue to see relatively strong data coming out of the US economy, as we have seen recently. I mean, look at the jobs data. We saw 519,000, I believe it was in January for the non-farm payrolls, much stronger than expected, nearly triple the estimate we had. Then it is quite likely that the Fed will, even if it sticks to its currently forecast, well, by the market's forecast, 5.5% pivot, it might not then lower rates before the beginning of 2024. And that could have a negative impact on the US economy, of course.
Sure. And that's the next point. I mean, I mentioned there were these three main focal points. The next one was growth. And that, I guess, tees up this next topic quite nicely. If rates do stay higher for longer, there's a lag effect. And I don't think we've even really begun to fully feel the lag effect of these aggressive rate hikes that the Fed put into the market last year. Is growth going to come under pressure? Are you in the camp that sees a recession in the US later this year or into 2024?
I am in two minds about this. When I did my presentation in January, I tried to present both cases, the positive and the negative.
Yeah.
And historically speaking, if you go back to the 1970s, because we were just talking about the inflationary spiral in the 1970s, when you have inverted yield curves, then what tends to happen is that when the yield curve normalizes again. I mean, here, for example, when I talk about inverted yield curves, what I mean is, for example, the 10-year yield in the US and the 2-year yield. And when you have an inverted yield curve, you have investors expecting a decline in the long-term interest rate. And when that reverts back to normal, what usually tends to happen is we get a recession after that. And as you say, there's a lag of about 6 to 9 months. So this would be a negative scenario. And if you look at what's also happened in the past with regards to the Fed pivots, I presented a chart in January going back to the 1970s again, and every time we hit a pivot, then within the next 3 to 9 months, we had equity markets coming off. And when I say coming off, I mean the S&P dropped by between 27% and 58% in that time period, all the way up to the current decade. So there is this underlying risk that once a pivot has been reached and once the inverted yield curves normalize, that recessions tend to happen. So that would be the scenario for the bears, really. And it is a possibility. And right now, having looked at the charts more than anything, to be honest, I have the impression that we may well be in a phase where we are short-term topping out again. And if we were to fall through the January lows, then I believe the negative scenario I was just talking about with regards to a recession in the US rearing its head towards the end of this year or perhaps the beginning of next year is actually becoming more likely, with equity markets then likely selling all the way off again towards the October lows.
Yeah, that's certainly the way I'm seeing it as well. I mean, I'm a big level that I've been watching on the S&P 500 is 4,100. And whilst we were above that, I think it was feeling like it might be bullish, but we're back up below that level and quite well below it actually today. And that I agree. I mean, it makes me think that maybe we've just had a big bear market rally over the last 3 months, and we could be on the cusp of another leg to the downside. Your point that you made about when the Fed pivots, and then the fact that that's usually when the markets come off. I guess if we had to unpack a reason for that, why does the Fed pivot? Why does the Fed cut rates? Well, it cuts rates because economic growth is under pressure. And if growth is under pressure, well, then that's obviously negative for earnings, and negative earnings, negative stock market, right? Is it as simple as that?
In a nutshell, probably. But as you said, Garth, there are a lot of other factors which also play into it, such as market sentiment, how confident people feel about the economy going forward. Because if they don't want to spend money because they're worried about having to save it just in case things will get worse, and also at the moment, I mean, because of the high input costs we have everywhere and the high inflation with regards to food prices, etc., affecting not just the lower income earners, but the economy in general. And governments, I mean, this is unprecedented if you think of it, stepping in Western Europe to help the households and also small and medium-sized businesses with regards to their energy bills. That really shows you at what stage we are at the moment, and that people are really struggling with the inflation we're seeing at the moment. So yes, I mean, in a nutshell, you're probably right. But I also believe that the human element should never be excluded in that sentiment, and markets, financial markets, equity markets are driven by sentiment to a larger extent, will also be affected by that. And if people have to worry more about their food bills, then they won't be spending any money on cars and things like that, which are very expensive. So
yeah, absolutely. Something that you presented in your webinar earlier in January, which I was really interested in, and it surprised me, was a diagram from a friend of yours, Klaus Weber. And it basically, unfortunately, because this is a podcast, we can't show the visuals. But if I describe it, you looked at growth in earnings and movements in the stock market over the course of a year. And one would ordinarily think that strong earnings equals a strong market, weak earnings equals a weak market. I was very surprised on the diagram that you showed that it's like a scatter plot. There actually was very little link between strong earnings and a strong market and weak earnings and a weak market. I mean, there were observations on that diagram where you had weak earnings and a strong performance for the S&P 500 in that year, and vice versa. You had strong earnings with a negative return on the S&P 500 in some cases. So the distribution of those observations was very, very random, which I found quite surprising. But I guess that also then talks to your comment a moment ago about one of the things being sentiment that drives markets. And it's not just historic earnings, it's also what's the market expecting going forward. So, I mean, I'm making a lot of statements here. I'm not really asking you a question. The question, I suppose, that I want to come out of this is that if we can't entirely rely on those sort of fundamentals, then it brings in the question of using technicals. And that was really what I wanted to get to you, is your interest in technicals, which you highlighted at the beginning of this conversation, and how you use technicals to make trading decisions, to make investing decisions. You're a fellow of the Society of Technical Analysts in London. You mentioned that before. Funnily enough, we interviewed a guest 2 weeks ago who was Rajan Dal, who's also a member of the STA in London. Can you give us a little bit of background into, I mean, why is it that you like technicals so much? And would you place greater reliance on technicals in your trading decisions rather than fundamentals?
Absolutely. I mean, especially nowadays, I would only trade based on the technicals. I wouldn't even look at the fundamental picture, because at the end of the day, and this is what I find interesting in the market analyst role that I've got now at IG, is that I, amongst other people, explain why things are happening. But when we explain data, such as, for example, the PCE data today, this is backward-looking data. It's data that comes out every month, or in case of GDP, every 3 months. And there is a time lag associated with that data. And in the meantime, things can change. And this change you can spot on the chart straight away, because at the end of the day, you're just using one single variable that you're looking at, and that is the actual price. And the price right now is nothing else than demand and supply in this given, or at this given point in time. Yeah. So therefore, if I just analyze the price and really understand what the price is doing, do we see more buyers or sellers in the market? And also the fact that history, in my opinion, doesn't necessarily repeat itself, but human nature doesn't change. So in a way, it rhymes. Then you can put the two together and get a better, clearer picture, and also with clearer objective stop-loss levels than you could do with a fundamental analysis approach, or a pure fundamental analysis approach. Because with fundamental analysis, you have to wait for the data to confirm that you're wrong or right, and that might take a long time. In the meantime, if the markets move very swiftly, you could be a long way away with regards to risk compared to the position you have on, for example, now. And whereas with charts, I know, for example, I believe at the moment that we are in the topping phase with regards to equity markets, not just in the US, but also in Europe and also in Asia, then I'm wrong if we make new highs. It's as simple as that. If we make a new high, this bull market we've seen since, or bull market, I don't know, it might just be a bear market correction, but the up move we've seen since October of last year is likely to continue. However, if it doesn't, then the current reversal we're seeing has probably further to go to the downside. So basically what I'm saying is that instead of looking of lots of different variables, inflation, growth, all kinds of other data, I just focus on one thing, and that's the actual price. And thereby, first of all, I get the price instantaneously. I don't have to wait for any lags or revisions in the data. And secondly, I can just focus on one single variable, which I prefer, because the odds of getting things right when looking at one variable compared to hundreds are probably greater, in my opinion. So that's why I look at technicals.
Yeah. No, that makes so much sense. And I liked what you said there. I mean, a graph at the end of the day it's a graphical representation of that dynamic between buyers and sellers in the market at that given moment. And the price is the one and only truth at that given moment. So we're on the same page there. But let's talk a little bit about how you use your technicals. I'd like to get a feel for the type of technical analysis you do, because I think it's a school. It's an approach to the market that has become more and more popular over the years. I mean, I know certainly even in my early days in the market, and I'm certainly not as experienced as you are, but when I've been in the markets 20 odd years, and early on in my career, even then technicals were sort of looked at a little bit strangely as being this sort of weird tea leaves type of endeavor, but it's become more and more mainstream. What I want to understand is when you look at a chart, I mean, take us through the process. How do you analyze a chart? Do you start from a bigger picture and then zoom in? What does a typical chart template look like for you?
Well, that's exactly it, Garth. I try to get the furthest, the longest data set I can get my hands on, and I would then look at quarterly charts and then monthly charts, and then I would go into the weekly and daily timeframes. And with regards to the actual trades I put on or the analysis I do for clients, I would then zoom into the intraday charts, and that can be anything from 4 hours to hourly, and then 15 minutes and even 3 minutes charts. So those are my preferred ones, but it doesn't really matter. I mean, the main thing is what you want to do with technical analysis at the end of the day is to get the odds in your favor and to be able to ride a trend as long as there is one.
Yeah.
And markets, as most people, I think even people who just look at the markets from a fundamental point of view, agree on, is that there are trends in financial markets. I know the economic theory teaches us that, you know, there's the random walk down Wall Street and all that of thing. But we have seen since the financial crisis, at the very least, I think, that financial markets aren't rational all of the time. And therefore, we do get trends, and those trends you can ride and you can trade along, either on the long side or on the short side. So for me, it's very important to look at the longer term picture first to see where I'm at. And I will then zoom into the shorter term picture, because the reason I do this is also because if I were to, for example, want to go long on, let's say, for argument's sake, the S&P, if I wanted to go along the S&P and wanted to do so at 5,000, a round number, if in the past, I mean, this is not the case, but if in the past months and years, every time it hit 5,000, it then came off again, then that might not be a good strategy. And I need to be aware of those previous highs and the previous lows, because quite often markets tend to then trade or revert at these sort of levels again in the future. So it's very important to know about the bigger time frames. And that's what I also always say to IG's clients. If they want to trade, if they want to get the odds in their favor, what they should do, whatever time frame they trade at, they need to look at the next bigger time frame to see whether that aligns with their strategy. So for example, if you want to go short on an hourly chart, does the daily chart also point lower? Because if it does, the odds of you being right are greater than if it's not the case. It's like swimming in the ocean. I mean, if you swim with the tide, it's much easier to do than if you swim against the tide. And it's the same with financial markets.
Yeah, that's right. It's putting the probabilities in your favor. We've spoken about price on charts, and obviously that's the number one technical thing on any chart. But of course, you get all sorts of other interesting indicators. You can put your moving averages on, you can put on momentum indicators like RSIs and stochastics. There's volume, there's MACD. I mean, you can get quite complicated with this stuff if you want to. And I've certainly found over the years in my experience, some of the best analysts that I follow actually keep it very, very simple and really don't have a lot of indicators on their charts. But I'd be interested to know, what does your standard chart template look like? What indicators do you have on typically?
Well, Garth, as you said, I keep things extremely simple. I mean, I did probably what most people do at the beginning when I learned about technical analysis and had lots of different lines and indicators on my charts. It just became quite confusing.
Yeah.
Yes, I try to keep things very simple. I mean, not just for myself, but also for the readers of the columns we write and things like that. So I only have usually a candlestick chart on there, because I believe that the candlestick gives us a better picture of what's going on than just a normal bar chart, because we can also see the body, the difference between the open and the close on a given candle. So that could be a daily candle or hourly candle, etc. And what I then do is I do draw trend lines on my charts. And we can see on the S&P, for example, if you go back to the high we saw in January of 2022, that downtrend, if you drew it on your charts correctly, is where the S&P has held over the last 3 days. And interestingly enough, also, if you draw an uptrend from the October lows, that's more or less where we bounced off in the last few days. And today, I think we might actually be slipping through that at the moment.
Yeah,
but
it looks like it, yeah.
Definitely. And that is really critical. So you can use old trend lines. If they get broken because of inverse polarity in the future, they might then act as the opposite to what they were before. So what I'm saying is, in an uptrend, if you leave an old uptrend, which was really important for several years, on your charts, quite often when it gets retested, it acts as resistance. And in a downtrend, when that gets breached, it then acts as support, as was the case yesterday and the day before for the S&P 500. Is no longer the case at the moment. So I do that. And what I then do, I only have 2 moving averages on my charts. And that is the 200 period, and I say period here because I use it for the day, the week, the hourlies, even on the 3-minute chart, I use my 200 period. Now, obviously, the 200 period moving average, most people would know the 200-day moving average, which approximates a year's trading, and is also a round number. I mean, most people are aware that traders love, or even investors love, round numbers. I mean, it's easy to remember. You were just talking about the S&P, most people talked about 4,000 or maybe 4,100, but round numbers are important to us as human beings. And therefore, I would also use the 200-day or 200 period moving average, and that in conjunction with the 55-day. Now, 55-day is a slight variation to the 50-day that a lot of people look at, like the 100-day as well, for example, in that 55 is a Fibonacci number. That's why I use that one.
Okay.
But that's just me. That's just personal preference. And then at the bottom of my chart, I only have a relative strength index, the RSI. And I use a 9-period RSI simply because I want to get an earlier signal. I mean, back in the 1970s, when Wells Wilder invented a lot of these indicators, he basically chose a 14-day period for his indicators, which is why the software nowadays has these 14 days.
It's the standard setting, yeah.
Exactly. But I prefer the 9-day simply because it gives me slightly earlier signals, and I'm just used to it, really. But what is really important with both the moving averages and the trend lines, is that all of this is additional information to the actual price. So for me, the most important thing is, first of all, understand what's going on with regards to the price itself, because that will give you far better information than any derivative of price, such as the RSI, for example.
Yeah. Something I find quite useful to do once a week actually is just to look at the price chart. So literally a candlestick chart with nothing else on it. No moving averages, no RSIs or stochastics or anything else, just the price. And it's actually amazing with a trained eye how much how helpful that is, I guess, without all the clutter of other noise from various other technical indicators. And then, of course, if you see something interesting, well, I suppose then you can start to add other indicators on to try and get confirmation. But like you said, price is the number one thing. Price is king. And all of these other things like RSIs and stochastics and whatever else they're all sort of secondary indicators which help to build the picture, but you can't trade just on those things alone. Price is king.
Yeah, I agree.
Yeah. Something else I just want to ask you about, because you're experienced in this game and you obviously represent IG markets now. Tell me about leverage and your thoughts on it and the way you use it. It can be very dangerous in the wrong hands, but very useful in the right hands. And I've noticed over the years, more experienced traders, I don't know, they seem to use less leverage. That's certainly the way I'm finding my life to evolve. Maybe it's just we get older and we're not so bold. But give me your thoughts on leverage and whether how we should utilize it.
You should be, as you say, Garth, very careful with leverage, because most people don't realize, first of all, what leverage can do to you if you're over leveraged. And a lot of investors, and that's probably why retail investors in general lose money, are over leveraged. I mean, professional fund managers, for example, most won't go over 2%. Risk per share they own, for example. Quite often it's far less. It's only 0.5% or so.
Yeah.
Simply because if something unexpected were to happen, like, for example, we had Rolls-Royce earnings out this week, much better than expected, and the share price jumped 18%. And if you had been short that share, and let's say you had pretty big leverage on there, and it was 50% of your capital, well, you would have been wiped out by that trade. And people forget that these things happen. And also nowadays that we have algorithmic trading and all kinds of high frequency trading and other quantitative systems trading going on, the odds of getting these black swan events or these extreme flash crashes or extreme movements and spikes in volatility are actually far greater than they were 30 or 40 years ago. And therefore, if you have a lot of leverage on, it can really ruin you. And I always say, for example, to IG's clients that we meet when they come to the office in London for workshops and things like that, that even if you risk 10% of your trading capital, spread betting, for example, it can all go horribly wrong, because, and quite a lot of them are surprised. I mean, 10% is not a lot, and that's fine, etc. But if you do simple math, I mean, I always show them a graph I have done with my trading coach, and we basically did a simulation of 20,000 trades and looked at simple strategies from a mathematical point of view. So we would say we have 100 trades, and in that sample of 100 trades, let's say we're right 50% of the time. So it's like a coin toss, heads or tails, whether you're wrong or right. Of course, what isn't included in here is that you have the actual spreads when you're spread betting, or you have the slippage when you trade financial markets on the different exchanges, etc. So you have to always be aware that no matter what you're doing, the markets are skewed against you. That's the first thing. But even if it was 50% probability that you are right or wrong, on 100 trades, there's 100% certainty that you will get 5 losing trades in a row. It just happens. And in our sample of 20,000 simulation, the number was actually higher. It was between 6 and 7. So if you risk 10% per trade and you're just unlucky, but it is likely, well, it's not likely, it's 100% certain to happen over a large sample, is that you will lose half of your capital. And if you lose half of your capital, you need to make 100% just to get back to break even. And these simple mathematical calculations, everybody should know about when they are trading in a leveraged environment, because you need to be more careful. You really do.
Yeah. No, that's good answer. And as I expected from you, Axel, you mentioned in the webinar in January, there's 10 common mistakes that traders typically make. And I want to quickly run through each of them. The first one we've sort of talked about already is over leveraging. So we don't need to revisit that. The second one you mentioned is not having an edge. So talk to us about that. What do you define as having an edge?
Well, basically, do you have a strategy which on average makes you more money than it loses? And most people think they do, but they don't, because they've never back tested it. Or even if you don't back test your strategy, what you should at least see is that well, we were just talking about a sample of 100 trades, for example. Have you got 100 trades which can show you that your strategy is actually working? Do you make more money than you lose? Or is it just a guess? And even if you have an edge, you need to apply it correctly. So I could give somebody the best trading strategy I have, and they could still not make the same amount that I do and actually lose money for all kinds of different reasons. But an edge is basically just a strategy which is profitable over time. It gives you positive expectancy. It's what it's called as well. So you could, for example, only be right 30% of the time. But if on average your strategy makes, let's say, 4 times more than you lose on average, you would still be making money over time.
Yeah.
But even the best traders in the world, if they have no edge, then you can't over time win money. And I know sometimes people will say, well, no, I've made millions doing this and this and that, mostly because they were over leveraged.
Yeah.
But if you take a large enough sample of people in the world, let's say 100 million people trading, well, some of them are bound to be just lucky for a while, until they get blown out of their accounts. But yes, so an edge is, does your strategy actually work, at least on paper?
Yeah. Okay. Fair enough. Second one, or not the second, actually, the third point you said was not using a stop loss. That's one of the big sins of trading, isn't it?
It certainly is. And I was, talking to you just now about the increased risk over the last 20, 30, 40 years of having extreme events and flash crashes. And if you don't have a stop loss in place, then these sort of events could very rapidly wipe you out, and there's nothing you can do about it. And I know of quite a few very wealthy clients, for example, who have deep enough pockets to just ride out positions and not worry about it. But even to them, I would say that there is always the unknown one event that could wipe out your trade. And a famous, I'm not going to mention his name now, but a famous hedge fund manager I've been lucky enough to meet once, he told me, every trade I put on has got my name on. It's like a bullet. It's basically every bullet's got my name on it. And every trade is a bullet that could misfire. So he always thinks of the risk first and then his potential profit. So that's why you should have a stop loss in place, even if it is a huge, long way away from where you are at the moment. Have one there just in case.
Yeah. Doubling down and averaging down, that's also a fast way to the poorhouse, isn't it?
It certainly is, because basically what you're trying to do is you try to regain the losses you've made, and then you quite often, because you are stressed and not in a good mental state, etc., will have less discipline. And if you do then make more mistakes, you actually make bigger losses on top of the losses you've already made.
Yeah.
And this stems back to, well, human behavior. We are loss averse, and we will. I know everybody probably has done this in the past, or might still be doing it. For example, you have a stop loss in place, and then the market gets close to a stop, and then you move your stop away because you think, no, it's going to be fine. And especially if it worked in the past, it's going to be fine again going forward. But if you do that and your stop gets hit, then your initial risk has become much greater than it was in theory beforehand, and you can just screw up the whole strategy you have. So doubling up is actually making things worse, in my opinion, and you should never do that.
No, exactly. I always have a metaphor. I think if you've got a hole in your boat, you don't drill another hole to let the water out.
Exactly.
Right. You plug the first hole.
Yeah.
And I guess doubling down and averaging down is equivalent to drilling another hole in your boat.
Yeah, no, it definitely is. And don't forget, I mean, some companies, for example, go bust. I mean, Enron, I remember back in the day, it's even cheaper now. Now I'll buy more now, etc. Look at Coinbase recently. Yes, we had a great rally in the last few weeks, but what did we see before that? I mean, you needed to make, if you held on to this trade and added to that position, you probably need to make 900% to make back the sort of up to 90% loss you had at one stage.
Yeah, keeping losses small is so important in this game. Next point was not having a trading plan.
Yes, again, I mean, the problem is nowadays, especially with the possibility of trading on your phone, it being constantly in your hand and you being, how shall I put it, tempted, let's say, to put a trade on very quickly because you see something on a chart on your phone. That's just your intuition trading. It's not you following a devised strategic plan which you've put in place before you even started trading. And by that, I mean a trading logbook. I mean a spreadsheet, for example, where you put in the reason why you put on a trade, when you do so, what time, the chart that goes with it, where your stop loss is, where your potential target is, and why, etc., etc., etc. If you don't have a plan in business, then you're going to go nowhere. And trading has to be treated like managing your own company, like having your own business. You need to look at all the risks. You need to make sure that you've got contingency plans in place. You need to have a strategy. You need to plan ahead. You need to do all of these things. And the same with trading. So if you don't have a trading plan, you can't go back in time and say, okay, let's just look at the last 3 months and see why am I currently in a phase where I'm losing money. And if you have several hundred trades that, for example, you did over the last 3 months or 3 years or 30 years, you could then say, oh, actually, by analyzing my data, I noticed that only these 3 trades where I moved, for example, my stop away, and I lost 4 times more than I thought I would, they were actually the ones that contributed to the biggest part of my losses. So it makes you realize where your errors are being made, etc. And if you don't have a trading plan, you don't know where you are and you don't know where you're going to.
Yeah, no, absolutely. And then there's a long list, so we won't touch on all of these 10 things, but we also mentioned no money management, which I guess it kind of leads back to some of the other things that we've spoken about, and no risk management is another one. Not knowing what your risk is, not knowing how much you can lose on a trade, leaving that as an open-ended number, that's also a cardinal sin, isn't it?
It definitely is, because going back to my example of being right half of the time, if you traded a strategy with just 50% probability of being right, it doesn't take a genius to figure out that if on average you lose more than you win on your winners, then by definition you're going to lose. And it's unfortunate, but a lot of retail traders don't think about the risk before they start to trade. They think about the potential profit and what they could do with that money and all the rest of it. Whereas a professional trader will always go in to a position and say, okay, what is my risk here? And if you work for an investment bank, for example, you know straight away that if you blow your limits, you're out of a job.
Yes.
So the risk is very clearly defined. And since you don't want that to happen, you make sure you get nowhere near that maximum risk that you can actually use up. And retail traders don't have that necessarily, because some people just blow up their account and then they try to fund it again in the future. But if you don't manage the percentage risk per trade you put on, as we mentioned earlier on, Garth, maybe 2 or 3% maximum of your overall total account size, and you start trading 20, 30% of your account on each trade, then there is a mathematical certainty that over time, eventually you'll go bust.
Yeah.
And that's why risk management is so important. And that's why when you start trading, you should always say, okay, where's my stop loss? Let's say it's, 100 pips away. Well, if it's 100 pips away, I will put my stop in straight away. Now I go, let's say, long, if in this example, and I then try to make, on average, let's say, twice as much as I'm initially risking. And if you consistently do that over time, even if you're less than 50% of the time right, you will make money.
Yeah.
But if you don't have any of this in place, then there is no way you can make money unless you're lucky. But that won't last forever.
No, luck doesn't last forever. Quite right. Axel, we're heading towards the end of our allotted time. I've got one more question I'd like to ask you. What is it, do you think, that makes successful traders successful, that differentiates them from the unsuccessful ones? And I know this is a difficult question to answer because there's various different things. But I mean, if you had to pull out one particular thing, what do the successful traders do differently?
I'll give you 3, Garth.
Okay,
First of all,
good.
The edge. I mean, you need to have an edge. If you don't have an edge, then you can't beat the markets. It's simple as that.
Yeah.
Secondly, you need to have discipline, because if you're not disciplined enough to trade the strategy as you've developed it, and if you don't follow your rules, and if you don't stick to your trading plan and stick to your stop loss levels, for example, then over time you won't be able to make money either. So discipline is the second one. And the third one is resilience, because no matter how good you are, it is never a straight upward curve with regards to your P&L. There are peaks and troughs, and you need to be able to trust yourself, to trust your system, and to also just survive the drawdowns and be able to continue, not just from a monetary point of view, but also with regards to your own mental well-being and all the rest of it. So you need to be quite resilient if you want to be a trader. It's not an easy thing to do.
Yeah, they say it's a hard way to make an easy living.
It certainly is.
It certainly is indeed. Yeah. All right, Axel. Well, I'm going to wrap it up there. It's been wonderful speaking to you. It's been a privilege, as I said at the beginning. So thank you very much for giving me 45 minutes of your time today. I think the listeners are going to enjoy this podcast. So thank you very much. And I hope we speak again at some stage in the future.
I'm sure we will, Garth. Thanks a lot.
All right. Thank you, Axel. Bye. Thanks for joining us for today's episode of Talking with Traders, brought to you by IG, a world-leading CFD provider. We really are privileged to have such a leader in the field of online trading involved in this series. Please follow us on Facebook and engage with us there. And a reminder to make sure you subscribe to this series by clicking on the subscribe button on your favorite podcast app. If you've enjoyed this podcast, we'd also appreciate if you'd leave a review on the app too. Till next time.